Nehemiah, welcome to the show.
Yeah, thanks, Owen. It's great to be here.
We're going to talk about private credit. We're going to talk about a product in particular called TermPlus. And this is a product that when I heard that you and I were going to do this interview last year, I was like, and I checked out the website and I hadn't heard of it. I was like, this is going to be really interesting. And Mitch assures me, Mitchell Snedden, assures me that you're the right man to take us on this journey. So we're going to talk about income, passive income, how this product works. So if anyone's looking for passive income, conversation around what goes into private credit portfolios and how that kind of molds together into an investment that has asymmetry around the risk versus return, this is the conversation. But in anticipation of this, we did hear on the grapevine that you are a fan of something called Kapalua Golf Course. And I thought that this might be something interesting for us to start. Now, the majority of our listeners, Nehemiah, are coming through in audio, not video.
Okay, yeah.
So you're going to need to paint the picture of this place. We've got the benefit of Google. What is this and what makes it so special?
Okay, so there's kind of two parts to the answer to that question. The first thing is why you go and play golf and why would I even go to Kapalua? And then the second is what is Kapalua itself? Okay, so I became a real golf obsessive and tragic when I took it up for the primary reason that I think it's the only sport that or it's probably one of the best analogies to life that you can find. Okay. And it's the kind of thing where you can actively practice respect and integrity. That's the truth, right? Because when you think about golf, so everything about golf is what you put into it, you get something out of it, but you can practice forever and never be perfect. So you're never perfected, but you do get reward for effort over time, number one. Number two, when I say it's a practice of integrity, it's a rules-based game that's really about respect to the field or respect to other people you compete with. So if I hit a ball into the woods and no one can see me, and it's like I have no shot, I get a choice, right? I can move it and cheat and say, and hit this great shot. I can chuck it out, or I can call a penalty on myself. I can do what I need to do to get the ball out and then make sure everybody knew that I did it. Okay. And so in that way, I kind of like I get to practice integrity very actively when nobody is looking. And there's a real nice thing about that, right? And then the third thing is everything is about respect for other people, like fast play versus slow play, fixing pitch marks on greens, raking the bunker so it's better than what you actually had when you went in. Well, that's actually not about you. That's about everybody else and showing respect to everybody else who plays. So I kind of feel like those things are actually what you should have in life. And if you can teach people that, that's one thing. If you can give them an experience where they actually really do feel it every day when they go on and play on their own or with other groups, that's what you get. Okay. So that's how I got into golf. And then going to a place like Kapalua, well, my parents retired to Hawaii. We grew up in Boston, retired to Hawaii. And so every year it was a place, because I've got siblings in the States, we would come together and, it was central to Australia. Meet in the middle. So I don't have to fly 24 hours, right, to get home. And so when you mix going to a place like Hawaii with, an obsession with this sport for the reasons I articulated, you run into a place like Kapalua, which is in Maui. And, the thing that's amazing about it is how they carved it into the kind of local sort of topography and everything else. The views are unbelievable. The weather is absolutely perfect. It can be a bit windy, but it's absolutely perfect. When you're playing, you can actually see a bunch of the surfers because it's got one of the best surf beaches in Maui. So in one of the holes, you're just overlooking a whole ton of people who are just, out there surfing. And it's just kind of nice to be out in that atmosphere, and it's just beautiful and relaxing and all those types of things. So, Kapalua is just one of many, courses that I love. But a lot of it is kind of probably no different to parts of this country that you can go to, right? Because it's an island. It's got great weather. It's got beach. It's got golf. It's got food. It's got, plenty of adventure sports. And it's just a nice, natural place to be. So
I like it. So speaking of integrity, I remember playing with my late granddad, and I just put it down to his age, but he'd forget how many hits he'd have on the green, and that's fine. I'll take that. But I do respect that, and I like how you broke that down for us. I would encourage anyone to go and have a look at this golf course. It's like the greens on the edge of the cliff with the crystal clear water.
It's an amazing place.
Yeah. Okay, so we're talking about private credit predominantly here, and TermPlus, which is the product that kind of fits neatly into this. We've spoken a lot on the show in the past year about private credit because it's something that has kind of reached into investors' lives as a solution for passive income and part of a portfolio. But for folks who haven't heard any of the previous recordings that we might have done, mate, can you explain how you would explain it to friends or family, this whole asset class called private credit? And then I'm sure follow-ups will fall out of that. Okay,
yep, no problem. So what's private credit? I guess, the way I like to explain it really simply is it's not traded, firstly, right? So if you think about equity, you can go onto the stock market and you can buy equity. In this country, it's a bit more difficult. Absolutely, in the US, you can go and buy bonds that trade every day, right? These don't trade, firstly. Secondly, if you just look at what banks do, okay, banks are very big private credit providers for anything that they hold on their balance sheet. Yep. So when you go and you get a mortgage from one of the big, any bank in Australia, that's private credit. I'm making a loan, I'm the bank, it's you, it's bilateral, right? And you give me a bunch of information, I make sure I'm comfortable, you can service and pay me back, I make sure I get my security, and I give you money. Okay. Same thing with companies. You think about companies that sit on any major bank balance sheet, it's the exact same sort of bilateral relationship. So simply, all private credit is a bilateral lending transaction between a lender and a borrower that doesn't trade. And there's certain characteristics that actually are really beneficial to the bank as well as to the customer in that relationship. Okay. If we then go to, there's a very big difference in how private credit, structurally what happens with private credit here versus what's happened with private credit in the US. Okay. And in the US, what's happened since the GFC is, if you think about what a bank does, a bank takes deposits and then it lends out money off the back of deposits and a whole bunch of other financing instruments that they have. So when the GFC happened, one of the things that the regulator really was very concerned about as an outcome of that was having short-term at-call deposits being lent out on a long-term basis. Now, there was a credit crisis in the GFC where mortgages were blowing up at the same time. Okay, so banks didn't trust each other. But if you actually look back at what was sitting on those balance sheets, there was a lot of corporate credit, so companies that banks lent to. The problem for the banks at that point, when they needed liquidity to pay back deposit holders, they couldn't sell those assets. And those assets, those loans to each individual loan to a company would have a maturity of, say, 3, 5, 7 years. So what the regulators don't like is at-call deposits being intermediated into long-term assets because you create this massive mismatch. So what they did was say, okay, we can't have that happen for system stability purposes. And so what we're going to do is we're going to make it more penal for banks to lend into that asset class. We want them to be more distributors, or, analogy people use is moving companies versus storage companies. Banks used to be storage companies and make a nice margin. What the regulators want them to do is they want them to be moving companies, and they want efficient intermediation, and they want to match the duration of a loan with the source of funds. And that's how private credit was born. So now if you think about, if you're going to create a private credit firm, what really are you doing? Well, what you're really doing is you're taking all the elements that a bank has in terms of how it underwrites, assesses, and manages credit, and you're putting it in a much better package where you're more closely matching the duration of the asset with the maturity of the financing with the duration of the asset that you invest in. Okay, so that's hopefully that's a simplistic way of thinking about it, right? Yeah. And can you give listeners a sense, because we're going to talk about US and global private credit. Can you give listeners a sense of maybe the size of it? Yes. Okay, so and you have varying numbers in this regard, but at the moment, people would say it's hard to get full numbers on the industry, but it's about 2 to 2.5 trillion. Okay?
That's huge.
Yes. And over the last 10 years, it's grown at a compound rate of 15%. Okay. And, why is that the case? Number one, when you think about really since the GFC, the number of different events that have created massive amounts of volatility in traded credit markets, traded equity markets, right? So a lot of investors, particularly investors who are sort of exiting or near the end of the accumulation phase, who might have had balanced portfolios now entering into more of a pension or retirement phase, what you really want is capital stability and you want stable income and you hate volatility.
Yeah.
Right. And so the asset class, when I told that story about why it started or, kind of what happened in the GFC, combined with people's desire in the first instance, institutions like insurance companies, pension funds, et cetera, who are saying, geez, I just torched my annuity portfolio because I thought 60-40 at the time worked and it actually hasn't worked for me. Or, I lost a lot of the capital value of the asset because of the volatility in markets. Sometimes it has nothing to do with the fundamentals, but more to do about how people trade on a day-to-day basis. Well, all these investors said, look, I like the fact that I can put money in and pick up an illiquidity premium in a fund that manages credit really effectively, right, and deploys that money really effectively. So as a result, you have this massive growth in the asset class because of the additional premium that you get relative to the risk. Okay, and that's why it's grown, and that's why alternatives have grown as an asset class more broadly, and the compound growth rate of 15% to now is only going to continue to go because you have too much money, when you think demographically, too much money entering into a phase where you want capital stability and income in what is a more volatile world. Okay, so that's what's actually caused the growth, and that's what is going to continue. You're going to continue to see this kind of, it's a structural opportunity. It'll continue to grow. I think the bigger issue is then how, as an investor, do you go and play in this asset class, particularly when you're in a jurisdiction like Australia and day to day, you're actually not sitting in the US and Europe and seeing what's happening and, seeing who the funds are and making decisions about where you should invest.
So let's talk about that. So TermPlus is brought to us by Pengana, which people will be familiar with. Can you talk about, obviously we're going to dive into the nitty gritty of returns, risk, these types of things and everything in between. But can you talk to us about kind of the mothership? Who's behind this? What is the business? And how can people get comfortable that the team and the financial resources and the skill set are there to talk, to go into this market?
Yep, sure. So I guess firstly, there's Pengana Capital Group itself, right? So Pengana Capital has been around for more than 20 years. At the moment, it manages about $3.5 billion in what are predominantly equity strategies. And then we moved into providing an alternative or a more liquid alternative to private equity. And now we've done that with private credit with that kind of, shift in investor requirement for kind of more stable returns or returns with less volatility. But if you look back at where Pengana Capital plays, it's very well known and has a very strong reputation in institutional markets. Right? We have a client base that's actually comprised of asset consultants, independent financial advisors, and a lot of the products that we've actually put together over time were really leveraging our understanding of what are the types of products that those types of advisors are actually trying to put into their portfolio construction. Okay, we have a very long-standing history of developing products that actually suit investor needs within the context of added value in portfolio construction. We also have the benefit of having a very wide, sort of more retail, high net worth, ultra high net worth kind of direct business. And with that direct business, we also get a lot of insight of, what are investors concerned about, what are the kinds of things that they're looking for, and then how can we develop product to deliver that. So that's kind of what Pengana Capital does and where its pedigree is. And it's got a very strong positive reputation, in kind of more institutional type markets. The other thing is, one of our most significant shareholder is Washington H. Soul Pattinson at the Pengana Capital Group level, with about 40% ownership. And, they came onto the register maybe 10, 15 years ago, and they actually bought the stake that National Australia Bank had in Pangana Capital
Yeah,
Group.
right. Okay, that's how it worked.
Okay.
Yeah.
And in actual fact, just as a little aside, that stake was actually born of relationships that I had.
Oh, right.
Because I spent a lot of time at NAB.
I remember that. Yeah.
When I left NAB at one point before I actually went back, and I was at JP Morgan covering financial institutions, our NAB CFO at the time, a gentleman named Mark Joyner, still a friend of mine, there was a strategy that NAB had called NAB Invest. Okay, and what that strategy was born of is actually what Pangana Capital does, meaning back at that time, which was, if you remember back, I think it was around 2008-ish or before GFC, actually, sorry. So sometime say mid or early 2000s. I'll probably get the dates wrong. But Platinum, do you remember when Platinum listed?
Yeah.
Okay.
Yeah.
So, well, if you look back at NAB's history, NAB bought MLC. MLC seeded a bunch of funds. So when Kerr Nielsen moved out of, BT and started Platinum, and then you had Maple Brown Abbott, and you had all of these different firms that MLC would be one of the seed investors in. Okay. But what was interesting is they seeded it, they helped get them rated, and they helped those businesses grow, but they never had equity.
Huh.
Right.
Okay.
And so when you start to see that happen, you go, well, we have a great platform. We actually help grow asset management businesses that we actually assess are sensible for investment for our investors and our IFA networks. Well, if we seed, we shouldn't just take, discounts on management fees. We should actually
have a stake.
Have a stake. All right. And so that's how NAB Invest was born. And Russell Pillimer, who was the founder of Pangana Capital Group, I've known from my investment banking days at Credit Suisse. We've been close friends from back then. And he'd started the business. And so how that all came about was, that was what Russ was doing. And I knew kind of the NAB Invest strategy, what we're trying to do at NAB. And we just, I got him and Mark together. And then what ended up happening is they invested. So anyway, so Soul Pass actually bought that stake. And they're phenomenal investors for Pangana Capital Group. And I guess as a great supportive shareholder, they really liked what we were trying to do to try to bring, what was a great asset or what is a great asset class, has lots of institutional demand because of its characteristics. But how do you bring that to Australian investors, non-institutional investors, but wider Australian investors right through to retail? And so, they played a part in providing the seed capital that actually helped us to kind of put together the master portfolio that, products like TermPlus actually invest in to generate the returns that support the returns that we're actually delivering to investors.
Wow. I love that. I appreciate that backstory because some of it I kind of pieced together, but I didn't realize that. And here are you in the center of it all.
Look, the great thing I like is I love the product. I get to work, with one of my closest friends. My whole career has actually been serendipitously driven by relationships that I've had with people.
Yeah.
And being lucky enough to work in organizations with products that I actually believe in, and sort of getting to work with people who I really respect, who I consider to be really good friends.
Yep.
And so, when I got the opportunity to kind of join to help, turn this thing from what was PowerPoint into something real, that's why I've got no hair left, right? But it's actually been, it's probably one of the most fulfilling things in my life is to be able to now have, when you're at a big organization, that's great. But when you're that close to what you're doing and you believe in what you're doing and you get to work with people that you really love and respect, it's like.
Perfect.
Yeah. Anyways.
Your reputation does precede you because after Mitch had come across you, he's like, this guy, he's going to be fun on the podcast. He is great. So he's
that's kind.
So yeah, it's evident for people that aren't watching and just listening. It's just obvious in talking to you. So let's talk a little bit about TermPlus then. So that PowerPoint is kind of matching those two pools that you mentioned before. You've got like demand from this marketplace, like as in like the businesses, the corporates and what have you in private credit. And you've got people getting older, and not just here in Australia, but globally. So where does that Venn diagram overlap with TermPlus? Like why was TermPlus at the middle? What is it? How does it work?
Okay. So firstly, if we just quickly start with, where does the demand come from? The demand comes from banks exiting the space.
Yep.
Okay. And when you look at private credit in the US and Europe, it's a consistent phenomenon from the GFC. Now, what's important about that is private credit into corporate credit. Okay. This is a corporate book, meaning it's companies, right? It's not retail.
Yep.
It's commercial counterparties. And within that, you have different segments of the market. Okay. At the big end of town, where there's some private credit, what you actually have is companies who are big enough to issue into traded credit markets. So when those markets are shut, private credit's a great alternative. There's another layer below where you have companies that are sort of billion-ish type size market cap type companies or valuation type companies that would say earn EBITDA between sort of anywhere from 10 million, which is what they call low middle market, to about 250 million, which is upper mid market.
Right.
There's a big rump in between that's around that 75 to 100 million of EBITDA where banks do not lend because they can't distribute. And if they do, it's a very, very narrow scorecard, very, very little flexibility, a lot of time so a lot of friction in the process. So when private credit comes in and replaces it, what it really did in the first instance is not just match duration, it was matching a value proposition, which is about, okay, I have a concept of what I want to do as a company. You listen to me, you can be confidential, you can be efficient, you can be really quick. And whilst there's certain things that you put in place around covenants and security, et cetera, you're actually meeting my concept to help me grow my business.
Yeah.
Okay. And you make it really quick, simple, and easy. Okay. So the demand side from companies came from a withdrawal and just ease of doing business or a customer value proposition. Okay. So when you then match that up with demand, the demographic or systemic demand, it's a great combination. So then you say, okay, I've got this. There's an additional what they call illiquidity premium that you actually get from this type of investing. And so, but it's kind of hard for investors in this market to access simply and efficiently. So we thought, okay, with this as an engine and with this as a great proposition for investors, how do you create products that provide access? And then that goes to, well, what kinds of products do people need?
Yeah.
Okay. And when you think about what people need, we have different types of products that we've built off of this master portfolio. The term account product had sort of a couple of things that we're actually trying to do with it. Number one, if you look at the different types of income investments that you actually have out there, well, one of the things that this does is we wanted to sort of provide shorter duration, kind of higher yielding term products. Because that's one part of the market where if I've got cash that I'm actually not doing anything with, and this isn't giving advice, I'm an investor. Yeah. So this is how I think about it. Where would I actually want to have that money? Am I willing to actually take the additional yield premium because I can't withdraw early? You can request it, but with this product, it's a 1-year lockup product because we have to manage the liquidity associated with it, right? So if you buy a 1-year product or a 2-year product, how do we price that in a way that delivers really nice income? That if I look at alternatives relative to the underlying, what can I actually afford to pay on a risk-adjusted basis for the investor? And as part of that, by having a 1-year lockup product or a 2-year or a 5-year lockup product, I can offer different types of spreads or premiums relative to what a very highly diversified asset pool, because we invest in 20 managers or 20 funds with different strategies, and on a look-through basis have over 2,000 individual loans, right? Because this is all about diversification, minimizing concentration risks, minimizing correlation risk, and providing really good risk-adjusted returns with capital stability and no or low volatility. Okay, so to package that up, we then created, okay, for people who are looking for, really nice income, it can be shorter duration or long, depends on what you're looking for. That's what TermPlus is for. Now, what we did with TermPlus, because it's not an institutional type product, it was really a direct-to-consumer product, is, for your investor base, which is, or I guess your followership, a lot of sophisticated investors who can get their minds around it. Right? But some people don't want to read about it, don't want to know about it. They're just looking for something simple and easy. Well, we provide everything you need to understand that. But what we did with the term accounts is saying, okay, well, if you don't understand the engine, if you don't understand what sits there, it doesn't matter. It's like walking on a plane. You just want the plane not to go down. And there's plenty of redundancy built into planes so they don't go down. right? So with this, it's not only do you have the great characteristics of the asset class with a lot of diversification that sits around it, we also co-invest in the product.
Yeah.
Okay, so that's the difference between some of our other funds, where we're not a co-investor, we're a manager of funds where you can get different risk-return profiles. With this specific thing, it's, okay, you're buying an engine that's highly diversified, that has all these great characteristics that I've already talked about. And if you don't want to go into all the detail to read about every single little thing, the one thing you do know is we put our money where our mouth is. And so 5 cents of every dollar that's invested, we put our own capital in. Okay, and when we do that, we provide two things. We actually provide priority of capital and priority of income. Okay, so we have a pool of over 2,000 loans across all of these different funds that are all bilateral loans that are actually paying monthly or quarterly income. Okay, broadly speaking.
Yep.
There's other strategies that also do other things, but that's the predominance of the portfolio. From that income, there's a return that comes through that then allows us to pay that RBA plus 3 or RBA plus 365, RBA plus 415 across our 3 products, that allows us to pay that. Now, in return for then providing what we call income priority, so that 5 cents, that priority of income is, number one, if there's insufficient yield to pay what we promised you, then we will actually pay out our own income to top up to get to it, number one. Right? Number two, if for whatever reason there was some reduction in the value of the capital, so you invest in $1 and let's say it was 98 cents for some reason.
Yep.
Okay, now there's a lot of things that would have to happen for that to happen, but let's say that happened. We will still be paying you your RBA plus 3 on $1.
Right.
Okay. And then thirdly, that's the income supports that we have. And then thirdly, on capital, what we do is to say, okay, when we return money to you, the main thing is that you get your balance back. Okay, so at the end of that term, if the value of the asset is not at $1, right, and the accumulated returns that you have, if that doesn't add up to you getting your actual investment back, then we will top it up by 5 cents. So if it went down to 95, we'll pay you $1. And then after that, obviously, you take the risk.
Yep.
But what we're really doing is saying, okay, we have a great engine, a great diversified portfolio. There's multiple layers of, call it, redundancy that's actually built in the way we constructed the portfolio. And then on top of that, particularly for those who, don't want to have to understand every single thing about the asset class, and we suggest everybody should, but they can actually be rest assured that we're also putting our money where our mouth is because we actually believe in the product, right? So that's kind of some of the reasons why we constructed it the way we did.
Yeah. I
think the other thing I would say is it's a digital channel. Because one of the other things that, and this is, I've spent in a lot of my career, spent a lot of time, also in and around sort of digital and uses of digital, as engines for, I guess, facilitating kind of ease of purchase.
Yep.
Financial services has always been terrible at it until you had neobanks come to the fore. Well, one of the things about how we wanted to construct this was we want to say, okay, one, we need to have a great investment product that delivers the best of the asset class to people. We also want to make it as easy as possible for people to be able to access it. And we want to create a phenomenal experience. And all of the tools that are available to create that experience are now available to everybody.
Yeah.
And we get the benefit of starting from scratch with a clean sheet of paper. So the reason why we've kind of set it up the way we've set it up is because, number one, it's very easy for you to go and buy the product and get educated on the product. It's very easy for you to onboard. So if you think about like UBank at NAV, because I was part of that team, not that built it, but was in the group when we actually kind of made UBank happen. And I got to observe actually the whole way that was done. And it was just amazing how back then, I think within 15 minutes, you can open an account with AML, KYC, all those types of compliance things. Well, why not leverage that to make it really easy for someone who wants to invest, make a really quick, simple, easy, seamless process, right? And secondly, the service proposition around, well, if you have a question, you'll have someone during business hours who will immediately be there to chat and to actually help you through the process. And I would say if it's 10 at night and you invest and you're not sure of something, someone will respond to you first thing in the morning when they start, right? So we wanted to create something that made it really simple and easy and frictionless to invest if you decided that you wanted to.
Yep.
Okay, so those are the two things about the product. One is getting access, identifying what the different things that people needed, and actually putting our money where our mouth is so people can actually at least feel like we're really aligned and they can see that alignment. And then the other is to make it really easy for them to do.
Yeah. It's interesting, and I appreciate the analogy and the links you went through there. Most people don't know how their car runs. Most people don't know how an ETF works, and they've got like their life savings in many instances in that. And in this example, it's very similar in this example. Like there's this market that is emerging and has been emerging for quite some time, but it can't be accessed in those traditional ways. So you basically put a digital gateway in front of professional portfolios. And I think just to hit the thing home for people here. So I had a question that was prepped for today, which was, so on the website, this is the thing that blows people away, right? To kind of wrap up what you just said is like TermPlus states it has a 5-year account targeting 8.5% per annum. There is an asterisk for sure. And when you compare that, like over 5 years, that's the term, right? But that's the longer duration one.
Yes.
The Aussie market, total return terms, not including franking credits and all that, total return terms for the S&P ASX 200, 10 years to the 10th of Feb 2025 was 8.2%. So effectively, now that's obviously, there's like an asterisk, and we've got to read the PDS and do all that sort of stuff. But effectively, there's kind of like this RBA rate, which that can fluctuate. And then there's like this fixed bit on top. But people would hear that and they would be like, what? Like this is almost too good to be true.
Yes.
And that's what we tell people in finance, obviously, because we have to protect them. But, but that is really, really compelling for people who understand that there may be some risks involved, but at the same time are worried about, like, say, retirement, or they're in retirement and they're thinking, well, these finance people were saying 4% a year. Like, can I blend one of these in, or can I do this, or can I do that? It's basically taking what is currently available to like the big pension funds and all those institutional investors that you mentioned, bring it to the front and saying, hey, here's an income suite, that may appeal to that. There was an interesting, which I just took from the TMD, the Target Market Determinations on the website. It says, over a 20-year period, the issuer considers that TermPlus is likely to experience up to 1 year of negative annual returns, which, for context for folks, in my words, is very, very, very low.
Yes.
And so, like you said, with the volatility substantially reduced income proposition, it's easy to see why these things are super appealing and why you saw that years ago, right?
Yes, 100%.
Yeah. Okay, so I've got a couple of questions around this.
Yes.
The first is a question that came through from our community, which wasn't specific to TermPlus, but more just the asset class generally speaking, is what do you see? You've been in this world for a long time. What do you see as, whether it's a financial advisor, a family office, like private wealth group, or an individual investor, what do you see, or what do you think we might see in the future, if we can kind of put our lenses into the future on, of like what would be a typical allocation range, or how do people think about constructing a portfolio around something like TermPlus and private credit, generally speaking?
Yes. So different layers to that.
Yep.
So if we take, say, the professional investor layer or institutional layer, right? What you'll find is, if you break it down, you've got sort of cash, fixed income, equities.
Yep.
There's a fixed income product.
Yep.
And then from there you say, okay, within fixed income, you've got traded credit and now you have private credit. I'm not going to talk about alts. So forget that. Forget that for a second. Yep. It's simply fixed income for the most part. So what you'll find is a lot of large institutions will allocate anywhere from, say, 5% to, say, 15% into their fixed income bucket, or they might put it in an alts bucket because it doesn't naturally fit in fixed income, which is generally traded credit.
Yep. Okay, got you.
But a way of thinking about it is, if I want a fixed income investment, I don't want volatility, and I have some duration tolerance or illiquidity tolerance. Okay, so our 1 year product is 1 year.
Yep.
You can't get your money out until the year's over, right?
Yep.
We have another product that's 3 years. You can't get your money out until after 3 years, but there's a much higher return attached to that product. Okay, so I think the main thing to think about is, with this asset class, is you're getting a really nice return relative to the annualized volatility. And if you compare private equity would be the same, but private credit in particular, and you compare it to any other asset class outside of private equity, so S&P 500, any equity index for the most part, investment grade bonds, high yield bonds, leverage loans, those asset classes will have a volatility, an annualized volatility that exceeds the annual return, which kind of says, well, you got to make sure you've invested at the right time, or you have to have a strategy, which is to consistently accumulate because you average up and you average down to then get the return. Now, for people who don't have volatility tolerance, so as an example, family example where, have retired, relatives will not invest in anything that's traded. Excess assets don't want to be in anything that's volatile because they can't help but look at and see what's happening to the underlying, and that drives a lot of fear, right? And lack of security. Well, in that instance, having something that's really stable, that doesn't have that volatility, that's got a very good, long-term loss rate performance, right? But still generates a really nice yield. It's kind of, peace of mind. Now that's kind of one use case, but in my own investing, I actually have private credit's a big chunk of my fixed income portfolio because I personally am not a big fan of. I don't like traded credit because I don't like the volatility of it. I feel like sometimes you can't capture the yield to maturity, right? Because a lot of open-ended traded credit funds are subject to now ETFs and kind of random decisions by people that can drive volatility outcomes that have nothing to do with the underlying.
Yep.
And as a result, in this, so from all my traded credit colleagues and fixed income investors, et cetera, I'm not denigrating. It's a great product. And, for me, I don't like to see it. I'd much rather have my money in something where I have really, it's my fixed income, it's stable, it earns a nice return, and I'm capturing the return that's promised based on kind of what I've been told and what I see in the research I've done, rather than being subject to what somebody on the other end of and no offense, someone who's day trading fixed income or an ETF that actually has to generate liquidity in times of fear. I just don't want to be subject to that at this point in my life because I'm hopefully heading towards pension phase and probably at the back end of accumulation myself, given my age. So, it provides a nice, sort of option for those people. But the long-winded answer, I guess what I'm really trying to say is you got to determine it yourself, but, really look at the asset class and the risk reward that you actually get. And then you can determine sort of based on your life circumstances kind of where it best fits for you.
Yeah. No, you've given us a great range there. Another thing that people don't understand is how the bank pays them a term deposit rate. Like most people you just put the money in the bank, right? And they don't realize that actually behind the scenes, NAB, let's use that, seeing that we use it as an example, takes your money and lends it to someone else.
Yes.
Right. That's the gist. And they make their 2% profit margin, their net interest margin. And that's how it works. And so it's not like magic. The bank just doesn't give you more money for no reason. And if you think about this as an extension of that idea, effectively, you step out, this is my words, you step out onto the risk curve a bit, but you're getting a different product. And with that comes a substantial increase in the kind of expected return through time. Just to clear it up for people and for my own benefit, but you mentioned, there are the lockup periods, which are pretty standard, like 1, 3, and 5 years, if those are the three different options.
Yes.
You can elect to have the income monthly. Is that correct?
Correct.
Yeah. Okay.
So all income is paid monthly.
Yep.
And what you can elect is, do I want to get cash payments monthly?
Yep.
Or do I want to reinvest?
Yep.
And compound? That's your choice. Those are your choices.
Yep. That makes sense. Okay. So I've only really got one more meaty question is so we've kind of set the scene for what is the marketplace, how that's been matched with a product that can help people access that in a regulated way with the PTS, with the TMD, with the publicly listed company, with the backing of shareholders and insiders. So it all sounds great, right? But everyone listening to this or watching this will want me to ask you a very simple question, Nehemiah, which is, well, how do you guys get paid? What are the fees?
Okay. So the way we get paid is we effectively get paid the differential between what's being earned on the asset and what we pay out to investors. Okay. So, when you think about it, how does a bank make money? We are not a bank. Right?
Be very clear about that. Bold text, not a bank.
We are not a bank, but, I use it as context because at the end of the day, you raise money and you invest that money at a yield, right? Now, the difference between what's earned in our portfolio and what we pay out to investors is effectively what we earn, right? And so in return for your 1-year money getting RBA plus 3, your 2-year money, et cetera, what we're doing is we're putting our own money in to provide those additional supports and comfort, if you will.
Yeah.
Right? So effectively, I guess technically what you're doing is you're trying to minimize the probability of loss at the end of the day, right? What's your loss given default?
Yeah.
Right? And so if you think about loss given default, we're trying to minimize that with our own capital, right? To provide more comfort and et cetera. But in return for that, what we do is we actually earn the spread over and above what we pay.
Yeah. So you guys eat your own cooking.
100%.
And you want to make sure, and as the TermPlus product and platform gets bigger and bigger and bigger, in theory, you guys like at Pengana should make more money, which is an incentive for investors as well, because you're getting rewarded, which means you're going to do a better job, because as your pie grows, you also need to protect more and more investors.
Correct.
Yeah.
And so the way I think about it is the more we grow, the more our capital base grows, those returns actually help support the protections that we actually have in place.
Yeah, exactly. Yeah.
And so it's sort of a win-win. And if it doesn't work, then we're going to end up giving priority to other people, but that's okay because we go in knowing that. And we feel confident enough in doing so, that we think it's a really nice thing to provide investors. So, that's kind of the basis upon which, when we thought about the product, how we wanted to set it up specifically for that purpose. Now, we have through that overall engine and access to the asset class, we also have different products that do different things where you collect the return and we pay, and you pay us a management fee for that. And there's other types of, restrictions or other things that actually come with it for you as an investor, and a different use case that you might have for why you want to invest in the products. So for us, any product that we develop is always going to be about, is there a sufficient enough investor need to actually justify the work that's actually required to construct the product to kind of deliver on that need?
Yeah.
And if it's big enough and you meet the value proposition, then that's what we'll do. The term account product was specifically built for the purposes that I articulated earlier. And, because of the nature of the product, and because, irrespective of, when you go and you read the PDS and you go and understand it, at the end of the day, there's always that question that you raised. Well, how do I know, you're just not putting this out there and you don't really care? Well, it's because we actually have skin in the game. And if we win, you win, right? And that was really important for us, with this product, particularly in an asset class that's not widely understood. And I'm hoping, say, in the next 5 years, if you go back, 25 years ago, my timing could be wrong, but there was a time where in the equities market, people only invested in domestic equities.
Yeah. Yeah.
Nobody invested in international equities.
Yeah.
Right?
ETFs aren't really a thing.
Now, who would be recommending that you just invest in domestic equities?
Yeah. Yeah. Exactly.
Right. And so I kind of look at it in 5 years' time. I'm hoping, that I feel like we pioneered bringing this in a digestible form to the market. Every major manager in the world is now actually trying to sell different products into IFA networks and to retail investors. And we think that's a very good thing. We think Aussie private credit is a very good thing. Why wouldn't you diversify beyond Australia? To diversify, broadly speaking, you get no upside. All you get is downside in credit, which means diversification is your best friend.
It's key, yeah.
Right. And that's why at the end of the day, 5 years' time, we want it to be ubiquitous. We'll continue to do what we do, right? But hopefully every retail investor who actually wants to get access to the characteristics can find some product that actually meets their needs. And I hope, with what we've done, that will be their first choice.
Yeah, I like it. I'm gonna throw this to you live on air. If we get a lot of questions, I'd love to have you back to answer some questions from our community, because I think a lot of people that listen to this and watch this will just be like, they visit the TermPlus website and they're like, this seems really, really interesting to me. It's definitely interesting to me. Like, as someone who deals with a lot of people that has SMSFs that can't get really any interest on their SMSF account, which is a whole bizarre thing in itself, family trusts and different tax structures where there's oftentimes there's just cash sitting there.
Yep.
this makes a lot of sense. Bucket companies, even operating companies in some respects. But this stuff makes a lot of sense to a lot of people in that sort of scenario. So if you are listening or you're watching this and you have any questions, after there's videos and there's big, amazing how-to on the website and also all the disclosure docs that I'll link to, that would be great. And just write into us and let us know. Mate, I'm going to catch you off guard here with one question I do ask to all guests. I know you've got kids, so maybe this is something that you do think about, but if you were to go back and give your younger self some advice, like you were to say, this is the thing you really need to know about investing, about business, about life. Maybe it's golf. Who knows? It could be anything. It could be literally anything. What would it be?
Gosh. Boy, that's a tough question, that one. Well, if I was to answer the investing question, just really simply, whatever you earn, never buy something that you can't pay for. Now, a house is hard. That's why you get a mortgage. But for me, I grew up, I'll never revolve on a credit card. Like, if I earn something, my expenses never exceed my income. And then with that excess, how are you investing it, right? Depending on your point in life. So I say to my kids, don't spend money on rubbish that actually doesn't create value. It's like a sugar hit, right?
Yeah.
Buying the latest phone, buying just whatever you earn, make sure I like to say 50% enjoy, because you may not wake up tomorrow for things that you have no control over, right? Can hit by a bus, whatever. So make sure if you work hard that you enjoy your life, and then make sure you have half that you save. But never let your expenses exceed your revenue. And then when I just think about life, go back to a golf analogy. I mean, my whole life has always been about, I don't think anybody is anything but an equal to me. And I don't mean that in an arrogant sense. I mean, I genuinely think, how you make people feel. If everyone in the world thought, it's not about me, if we're equals, no matter where you sit, and if I say hello to you and I'm respectful to you and I make you feel important, and if we disagree, I seek to understand why we disagree, not argue with you, I want to understand. And if I do that, then I can only do one thing, which is contribute to other people's lives, right? And I really believe that, and that's what I've instilled in my children. And I would hope that most people who've interacted with me over my lifetime kind of feel like I did that. No one's perfect, because I'm sure there's plenty who don't. But I think, in life, if you treat people well, it'll always come back in some way to reward you as a person, like just fulfillment. And then financially, just don't spend more than you earn, and you're probably going to be okay.
Love it, mate. Amazing piece of advice to end the show. And I know this is going to be really popular with our community, so I sincerely appreciate you taking the time to join me.
Oh, thanks for having me.
Thanks for watching this video on the RAS Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.